We have the Fed meeting starting today, concluding tomorrow. We find out about the interest rate decision, and even bigger than that, the summary of economic projections coming out and talked about extensively in yesterday's video. I'd like to take a look at the market and see how we're setting up for, well, we'll say Wednesday, and what exactly could happen today based on the pressures that we see for Wednesday, whatever remarks Jerome Powell might have to make at that 2:30 time slot. So let's jump right into the charts on this one, and we'll start talking about what we can see. So right now we're looking at SPY, and we are down below the 200-day. Woo! And bring those technicals down for a moment. Just the moving averages right now down below the 200-day. I think that we'd be hard pressed to break the 200 prior to seeing what exactly is decided from the Fed. And I don't think that the rate cut decision is the big thing. It's by the bond market standards a near certainty that we're not going to see a rate cut happening. And even if we did see a rate cut taking place, that emergency action by the Fed could be taken negatively by markets, not positively. So we want to be prepared for what exactly could happen there. So if they did happen to surprise us, pull the rabbit out of the hat and say rate cut right now, months before it's expected to happen, that could be the Fed showing signs of panic and needing to cut those rates immediately. So this 200-day, will we break it? I don't think that we're going to break it prior to what we have coming out, like I said, on Wednesday, seeing that summary of economic projections. And it's just going to be a wild ride. So day traders, be ready out there, play that volatility and those zero DTEs. I'm pretty sure that, and not financial advice, of course, but anybody doing that with that high risk movement, that's times that like these strangles could take place and had to a massive effect. For example, with something like that, where you play that volatility as that we near that 2 o'clock hour, usually around 1:50 or so, maybe even as early as 1:30, that we start to see the market really reacting pretty wildly to what could be coming our way. So the market, I think, is going to be particularly worried about what the Fed is going to have to say about GDP and then inflation. And then, it's going to be a weird balance between that with what we see coming out for that labor market as well. For instance, if there's a lot lower GDP, to say that the labor market's not going to soften more than they've already expected it would be a weird coincidence, in my opinion. So we also don't want to see that unemployment go up above 4.3%. So if we start to move north of that quickly, if they say 4.5% by the end of 2025, that's a raise from the kind of sideways movement that we've had over the past several months. That could be a bit of downward pressure for the markets. So then also the commentary that we get, if any at all, on tariffs would also be very welcome for the market. Now, mind you, we're looking to see what they have to say about the inflation implications, and the Fed has to weigh on it somehow, even if it is indirectly when they put out those inflation numbers. So what are we looking at here so far? Well, if we get rejected off that 200-day, then we can move out to the weekly chart to look and see. The 50-week right now is about what we're dancing around. So losing that 50-week would be absolutely huge. The 20-week is flattened out for right now. The 50 is still moving northward. So not the worst thing to see that happen. I will say that this is usually where you get that bounce. So let's say that the Fed puts out what the market perceives as a favorable SEP, summary of economic projections. We're at the level right now, being off these previous peaks and right around this 50-week right here. And we did close above it, by the way, so far. We are in like particularly good bounce zone right now to have just a wicked rally coming off of that, especially if the Fed signals that they're fairly dovish and that they're going to be moving potentially to, or that they're at least considering moving from quantitative tightening to more of a quantitative easing side of things. Even if they just let go of the rate of tightening, for example, if they ease up on that in any sort of direction where there would be less tightening, where they stop rolling off as much of their balance sheet, and that they continue to be like, we're just going to keep on tapering our measures that we do right now. And especially if they signal that there could be more cuts coming in 2025, that they say, we're in a good spot right now, and we want to make sure that we're addressing this appropriately. And in the light of the data that we have, we see that we've done enough, and it's time for us to start being a little bit softer in our approach. That could be bullish enough to push this up, and then we get a bit of a rally coming out of that. And then it's up to other economic reports out there outside of what just the Fed has to say. And then, of course, we got to watch geopolitics as well. So we could definitely come up off that 50-week that we have right here. And you can see the last time that we touched it was October of 2023, and the rise that we got out of that one. So we would like clarity on GDP. We would like to have our fears allayed that what we see in the Atlanta Fed GDP now is being just rearward, backward looking, not forward looking. is something that, okay, well, it was a bit overdone. We don't expect it to be that deep of a cut. And that would be something that also takes some of that downward pressure off the markets. So it might all begin and end with GDP this time, with inflation being that secondary thing. And then looking at unemployment rate, and then finally federal funds rate. Maybe in that order might be a good approach in terms of importance for what we're looking for that SEP. And then also the commentary and the tone that Jerome Powell seemed to come with. So I had this chart shared before that if we do happen to pull back, like let's say that it's not received all that well, and this is QQQ tracking the NASDAQ 100. This goes all the way back to the Great Recession and how far from, based on Fibonacci extensions, we pulled back during that time. Great Recession, 0.786, and all the other ones are from 236 to 382, and they all reference October 2002, by the way, as a low. So we have to go all the way back to this low back here in October to really talk about it. Or maybe it's September 2002. It's that October or August-October window, I believe. Let me see. I can confirm it here for you in just a moment. It is October. October is that low that we were talking about. It's right the first time. So that's the reference that we go back to for watching that climb. And when we were in 2022, when we were looking at, do we have runaway inflation? We have a lot of supply chain issues that are janking things up. The federal funds rate increases. We had a triple whammy, if you will, that pulled us back to the 382. So how bad does this get? Well, it depends on what's being signaled. If we intend, if instead of finding it comforting news from the Fed, if instead we get hawkish or bad news from the Fed, that 236 around 417 could be what we could be watching for. And that puts us just north of this previous peak that we had back here. And that peak happened at the end of 2021 and then going into early 2022 before that sort of sell-off. And then this, on the monthly chart that we're looking at here, that 50-month is that time when if things have to get really dark in order to make it there. So you can see that in 2018, we didn't quite make it there. We didn't even make it with the pandemic. We did not make the 50-month. We made the 50-month when we came down in 2022. That's how poor the sentiment was. And you can see when we reached that peak fear moment, just how much of a rise we had. And this is what I'm talking about when I talk about the weekly charts, which on QQQ, we're down below the 50 week on this one. So I don't know that we've reached peak fear. I think that we've reached peak fear for now. And right now the market had time to digest, recovered a little bit, and now it's waiting for that next thing. I think that next thing is the Fed meeting. That's the catalyst that we should be watching for from where we're currently positioned. Getting back on top that 50-week with some softness coming from the Fed, some dovishness coming from the Fed, being like, things aren't so bad. We just need to be calm and metered about this, and we're going to just keep on monitoring our approach. And we decided to be a little bit easier about our monetary policy. It's going to be threading the needle on this one. I'm going to be honest with you, but if they're able to pull that off successfully in a way that the market really enjoys what they have to say, we have that potential for that rise, and that's really what I'm looking for. I'm also ready to go with any number of positions that I have, hedging my long positions, to watch and see if the Fed instead still comes off, with being very tight-lipped about this and being seen as hawkish or short or anything like that, where they seem to come from like a fear or defensive sort of stance where they're trying not to look like they got caught on their heels again. So for this one, we would like to see some response from the Fed, but not enough where it signals panic. So last thing, we'll close off with a few more here. IWM, watching for this one. We're definitely in bearish territory with on the daily chart. Let me not move on from that so quickly. We almost have this pink 50 crossing over the orange 200 day. That would be that death cross moment. And we really, and I'll put the technicals back up for this one, that cup and handle, I would love to see this play out. Have a nice dovish Fed come out talking about GDP is actually going to be still pretty decent, even if it's a little bit lower than what we saw before. Monetary policy, we're going to start easing a little bit on that. We're going to have easier monetary policy, which is great for these low cap stocks. And then also, unemployment rate we still see as stable. We still have a very good reason to see a strong labor market from here, that we don't see it coming off the rails, and that inflation should be subdued even in light of the tariffs. So if they give us all good reasons to be positive on this, then maybe this is as low as we go, and maybe this cup and handle pattern works out for us. We don't go any lower than where we're at right here. I said no deeper, please, and maybe that's that next part of the rally. So we have a fair amount of signals when we look at the market. The market's preparing itself for either eventuality to come out that we either get a panicked Fed, which would be downward pressure for the market, or we get a hawkish Fed, which would be downward pressure for the market, or we get an unconcerned, slightly dovish Fed that's kind of, well, I don't want to say completely unconcerned, but they look at the market and they look at the numbers that are coming out and they're like, we believe that it's time for us to consider being a little bit easier with our monetary policies, with our stance, and also bring back our federal funds rate to bring the economy back into a greater balance with less restrictiveness in it. So they could absolutely do that. They could come off with the right message here that would allow the market to experience that levity. We would see a pretty massive increase, I think, especially if it pulls back on those GDP worries that the Atlanta Fed happened to put on the markets. But there's so much recession talk right now that if the Fed can change some minds in the market's eye to, perhaps recession isn't coming instead, well, then if the market believes that, if that's the bias that it goes with, then we could see good things from that. Guys, if you want to hear more of my commentary, also see my technicals and see the trades that I make, you can do so by joining our Discord. That link is down in the description. Make sure you use code word CASH to save 50% off your first month's sign up. And there are thousands of members over there. There's tons of trades coming out every day, trade wins being popped out all the time, and you can go and see all those take place, get access to the bread bot, the other AI tools that are over there, advanced charting tools as well, and just the products and services seem to be endless over there. And it's a very, very strong and positive community where you can find every sort of person that you're looking for that's going to help you with your trading and investment journey. So guys, thank you very much for watching. Don't forget about the link down in the description for the coursework that's down there as well, and use code word doctor when you sign up. I am Dr. Stock, Doctor of Education. Remember, my friends, that learning is earning. See you next video.